Today we are going to cover about tax due diligence. Now, due diligence is a process in which we understand the business of a target which is getting sold, or in which raising money in the form of fresh investment. And in due diligence, there are various parts which include financial due diligence, legal due diligence, operational due diligence, and tax due diligence forms part of the financial due diligence of that business. Now, in due diligence, the idea is to identify potential red flags in the target so as to understand before making the investment in the business. And similarly, tax due diligence specifically focuses on the risks that may arise from a tax standpoint by examining their compliances, ongoing or potential litigation, and tax positions undertaken by the client, by the target. In tax diligence is mostly covers both direct and indirect tax, and indirect tax also transfer pricing may be covered. We will focus more on direct tax due diligence here. A due diligence exercise can be conducted in two forms, which is one is buy side DD, which is undertaken by the acquirer, buyer, or the investor, and the sell side, which is undertaken by the seller or the target to prepare for the transaction. Now, as we discussed types of DD, so there are two types of DD. One is buy side and the sell side. Buy side DD is really undertaken by the investor or the buyer who is buying shares of the business, whereas the sell side may be undertaken by the target who is raising investment or the seller who is going to sell shares of a business. And buy side is further divided into two ways of conducting DD. One is full-fledged, in which you will get all the information from the target, and the other one is based on DD report. It is when the seller has already done a sell side DD, and now you get that DD report based on which you will do your due diligence. This is more common in industries or sectors such as renewable industry sector, where then generally the seller does get the sell side DD done. Now, what is the process of a due diligence? So the process generally involves, first of all, you share your information requisition list or IRL to the target. Now, if you are going to do a DD based on a DD report, then you may not share an IRL, or you may that come depend upon the nature of transaction, but generally you still ask for some of the information from the target apart from DD report. Then you will analyze the documents and the information shared by the target, and based on that you will prepare a Q&A on the information, and you'll do a Q&A with the target, and based on the responses received and the information you have analyzed, you'll identify any red flags or issues within the due diligence and prepare a DD report for the client, who could be the buyer or the seller. Now, what are the types of issues that you may cover in your DD report? So those can be broadly classified into 5 parts. Of course, there can be more types, but majorly these are the 5 kinds of issues. First is ongoing litigation. This is self-explanatory, like any litigation that is ongoing within the business at various levels. For example, could be at assessment level, could be at ITAT level, could be at CIT appeal level. Then there is an industry issue. So industry issue is something that is common or prevalent within the industry. For example, in the real estate sector, you have various disallowances of expenses, and it's very common for real estate companies to have multiple years of assessments on same expenses or similar types of transactions. Similarly, in startups, you will have the issue of ESOP expenses allowances, and that can be an industry issue. So those are some of the key industry issues. Or if in pharma sector, you will have an industry issue of payments made to doctors, whether it is a professional fees for genuine business nature, or it is the marketing related fees which should be disallowed under section 37. Then third type is past transactions or restructuring. So a lot of the times the target might have undertaken some restructuring in the past, some transactions, or raised some investment in the future, or there might have been some sale or something like that, which could have some ongoing issues or something that may be picked up or may not have been picked up by the assessment authorities. Then there could be some issues in relation to reporting or some misreporting, or mismatch in reporting. For example, there's been a disallowance in the tax audit report, but same has not been reported in the income tax return, or similar to those. And the last part related party transactions. And this can be significant in sectors such as renewables, where you will have transfer pricing related issues and other issues in relation to 94B. So these are broadly some of the a classification of various issues you might find during a due diligence. Now, some of the tips that you might want to keep in mind before if you go into this profile and do your first due diligence. First of all, whenever you start any due diligence, pick up the latest financials of the target. And if there are multiple entities, pick one with the flagship entity, or if the one with the most revenue, to understand the overall business of the target and the group. Because once you identify their financials and understand that, you will be able to analyze how they are generating the income and what could be the expense that you think they should be incurring. And then based on that, then look at the high value expenses that they have incurred and see if there is something unusual or something that might require a deeper analysis. And then go through the notes of accounts after the other expenses once, because those could have some information that may not be apparent from the financial statements or may not be there in the numbers. For example, the related party transaction bill or the disclosure in relation to litigation. And similar to that, you should also look for non-tax litigation as well, because that may provide some of the legal matters or something that may be led to another issue from a tax perspective. So you should broadly look over the financials thoroughly, if especially for the one big entity of the DD you are conducting. And some of the important terms you should know in due diligence. So one is the review period. This is the number of years which you have to conduct of due diligence. So for example, currently we are in November 2025, and let's say the client asks you to do DD for FY 23, 24, 25, and the by DD 26. This is from 1st April till 31st October or 30 September. So that is your review period. Then materiality limit. Materiality limit is similar to in audit, is the amount of issues that the client is interested in. So it could be 5 million rupees or something like that. And that basically any issue that you highlight should have a tax impact of 5 million rupees. Then only the client would be interested in it. Otherwise, he would ignore it. And then the documents that you will review during a due diligence. So this is just a basic list, but other documents will be depending upon the duty you conduct. So basic documents you will take will be financials, ITR, petition, tax audit report, 26AS, ASTS, and then based on these documents and the industry that you are doing, you will take other documents from the target. So before we end this one, there is an assignment for you. Choose any industry of your choice and identify a common industry specific issue that you may think would form part of your DD report. So for example, in case of startups, especially tech startups, the main industry should be the disallowance of ESOP expenses. So find something another and let me know in the comments below.